Hi, good afternoon. I'm audible? Yes. Okay, before starting today's session, I would like to take few questions if you have, but the question I preferred if you ask regarding our session, the relevant topics, because the other topic is coming down the line. So if you have any question from the previous session. Yes, participant, do you have any quiz or question that you want to highlight? Or any area that where you feel okay, the further insight you required? Okay, here are the ministerial decision, cabinet decision, FTA decision, the almost 31 decision that so far, but there is more, couple of other ministerial decision, FTA decision also there. The latest decision are also available online on Ministry of Finance website. So far, we threshold for taxable income the before that tax residency for legal and natural person we already go through. Okay, the threshold we already go through this part. Okay, the government entity. Okay, the small business relief we already have the insight on the small business relief. Then we will move to the another participation exemption we will go through, and adjustment under the transitional rule. This will be upcoming. These are yellow highlighted will be upcoming. And here the general interest deduction rule. This way interest capping rule. This we already gone through, and the couple of example also we did for the interest capping rule. But still, I have the couple of other examples also for the exercise. We will go through that part. But today I'm wish to start the determining the taxable income and tax adjustment to the accounting income. This will be our topic today, but the interest capping rule we will discuss. I have the couple, we already have the understanding very much clear, but there's a further another point that we will go through during this session. Okay, saying the voice is not clear. Let me fix this. Please confirm now voice is better. Please confirm now voice is better. Yeah, the last message, I believe the voice is clear. Yeah, thank you. Okay, so I was mentioning that there is a line item 22 that is general interest capping rule limitation that we go through in the previous session. Before that, with the name of interest capping rule. Okay, and then today we are going to discuss the line item 26, determining the taxable income and tax adjustment to the accounting income. This will be our today main topic. Yeah, hope voice is fine now. Now let's start today's session. Today, day 5th, of this session, day 5th. Let's computation of taxable income. This is the whole story, that whole study, the whole efforts we are doing. But this again, there is a lot of topic that we're gonna go through and we will understand. But on each topic that we will dive into section one by one. But most of the main idea of the tax computation we will understand. We will try to cover today's session, but it's a long session. It's a long activity that may not able to cover in this session. But hope see how much we can cover on this. Taxable income adjustment. So from where we start our competition, tax competition. The tax person or the tax consultant normally take the financial statement from the accounting team or the reporting team. Once, because as earlier also I mentioned, and we have to understand the segregation of duty between the different roles. There is a bookkeeper, there is the accountant, there is the reporting team, and then the tax consultant or tax accountant or tax reporting person. So this four stage, first stage bookkeeper, second is the accountant, the third is normally accountant we call the GL accountant. The next is the reporting, the financial statement, preparation of the financial statement. So these are the three steps before coming to the tax consultant. These three steps would be expected to be processed. And these three steps would be processed as per applicable IFRS standard. Just now one question is loss transfer. Please, such topic we will cover in detail, because even the standalone I will reply on that, may not be able to understand on that. Okay. Here now we assuming that these three steps already processed, the bookkeeping, accounting, and GL accountant, and the reporting. Now the tax consultant or the tax accountant taken the financial statement and starting to work on the corporate tax return preparation. Earlier we go through quickly this part. Now we will dive into the detail. Taxable income. As per Article 20 City Law, there is the 8 adjustment. The 8 adjustment from where we start. The computation will be started. Computation will be started from the accounting profit before tax. This is the second last item of the profit and loss. From this figure, we will take. Let me take the Once we receive the financial statement, our starting point for the computation of the corporate tax or the taxable income will be accounting profit before tax. Accounting profit before tax. And here we have, to start from that point, we require to meet 8 taxable adjustment as per the city law in accounting profit. Now, it would be 8 adjustment we might may come in our mind. This is very easy. Only 8 adjustment is required, and the corporate tax return will be ready. Let's see how the 8 adjustment will come, and on each adjustment, how many further adjustment will come. Now we are drawing the picture how many the total adjustment, then under each adjustment, how many the other adjustment is appearing. We already discussed that earlier other part also, where we said the financial statement have the 6 component, but normally we are familiar with the 5 component because the statement of income and the other comprehensive income, they prepared together. As per IFRS, they allow, we can make as a combined statement of the other comprehensive income also. So we have taken the figure accounting profit before tax, second last item in the income statement. Now, in this, we will make the plus and minus as per the Article 20, the 8 adjustment. Let's see. Now, from one of the 8 adjustment, okay, add back disallowed expenses and non-deductible expenses. So, disallowed expenses and non-deductible expenses, which means there are some certain expenses that as per accounting we already deducted, but the corporate tax do not allow to be deducted. Corporate tax not allowing to be deducted. So these expenses, which means already minus from the accounting, but tax authorities saying disallowed. So if already minus, which means our accounting profit is reduced. So now we have to add back, which means our accounting profit will be increased. Because these expenses, if we add back, so it will increase our tax base. It will increase our taxable income. So now our journey is start from the accounting profit to the taxable income. The whole exercise we're gonna learn today is from accounting profit to the taxable income. In between, we are discussing the many areas and many adjustment. Now the next is here, the fee. Let's go back. Add back disallowed expenses. There is a 12 disallowed item under this. Earlier we are seeing 8 items, 8 adjustment we have to do. Now we are looking into the first adjustment. Under first adjustment, we seeing the add back and disallowed expenses and non-deductible expenses. So under that, there is 12 disallowed expenses or item. So here under this 12 item, so now we'll keep tracking on this 12 item. These are already minus, we will add back to our accounting profit, and our tax base will increase, our taxable income will be increased because these expenses are already minus. Okay, now we will see the first adjustment we divided into the two. First is the add back disallowed expenses, and second is the allowed expenses. On the similar pattern, we are saying there are certain expenses that are disallowed, we have to add back. On the similar note, we have to see if there are certain expenses that may be not deducted, we will deduct now. So what we have to do, wholly and exclusively for the business purpose, if these expenses are incurred for the business purpose only, if these expenses are incurred only for business purpose, yes, we we can deduct. Even in accounting, we may have the different treatment due to any reason or as per IFRS. Here the tax law is saying these are the as per Article 28 of the city law, 5 item is allowed. So we can deduct if first we here the critical point is that even the tax team, they have to understand what are the adjustment the accounting team they already made. Accounting team, because if you have the disclosure notes to the accounts of the financial statement or the accounting statement, that will help to prepare the corporate tax return. If the tax consultant or the tax accounting team is not familiar, what are the adjustment is already made, so it would be difficult. It would be difficult because the accountant will not be familiar what are the adjustment already made. Here is one of the example. We have to see these expenses is already deducted or not deducted. Okay. So if not already deducted, so we will deduct now. If already deducted, so no need to make any adjustment in this regard. But these are the expenses we are saying wholly and exclusively for business purpose. The reason or the rationale of these expenses only for the business purpose. But at the same time, we have to ensure not in capital nature. These expenses in previous session, we also learned not capital in nature. Because not capital nature, because if there is a capital item, the asset amortization depreciation expense is allowed. If some expenses we made for capital in nature, that will be part of the balance sheet, but depreciation over the life of the asset we will proceed. We can deduct. Okay, now the next part we have according to the tax period. Okay, wholly and exclusively for business purpose, not capital in nature, according to tax period. Record expenses in the relevant tax period as per the matching concept or as per the accounting principle, we can say over here. What does mean? Because normally, even in the other session also, the common question from the client, all the other participants, they normally used to ask, okay, we have these expenses. So in current year, we have the huge profit and the expenses are incurred in the first week of January of 2025. Can we take back in the previous year to reduce the tax base? Now the expenses are not belongs to the 2024. If their accounting tax period is at December 2024, so they are asking the question, okay, these are expenses just incurred in the first week of January 2025. Can we adjust in the previous year? Here we have to be ensure that as per the applicable accounting standard, all the treatment is done according to the tax period. If the expenses are incurred in the relevant tax period as per the accounting standard is permissible, so we will book over that. We may book the provision or the accrual based on the as per the accounting standard as accounting practice. The next is not in personal in nature. Okay, after that, these are the fifth item, allowed expenses as per the ministerial decision. So these are the 5 items that we are saying these are the allowed expenses. While if we see that some expenses, the accounting team, they put some disclosure or notes is not deducted, and the rationale of this behind these 5 expenses are meeting, so we can deduct. So these expenses we can deduct. Hope this point is clear. Now we will go back and see the here the 12 item. Okay. Still, we are on the first adjustment where we are discussing add back and disallowed expenses and allowed expenses. Now we're gonna see the disallowed 12 item. Okay, now we're gonna see that the list of disallowed expenses written in the Article 33. These are the 12 points we are discussing here. Now as we're gonna see one by one in detail what are these 12 items as per the Article 33 of the city law. Before starting that, I would like to ask you guys, hope I shared this article in the group also. Would you please confirm how many participants go through these articles? Just quickly. I wish to see the checks. Because if you've seen that, go through that article, I will explain in the further, considering that part also. If you did not go through, if I explain in the further detail as per the article, that may be challenging for you to understand that perspective. So that's why I'm just looking your response, if you already go through that or not. Yeah, the go through means just like a newspaper. You have to read just like a newspaper. I'm not expecting you guys will understand, but the idea is that it must be go through as a just we are reading the newspaper. Okay, now we're gonna start that. Now the 12th item as per the article 33. Below listed item below, this is the first item that we're gonna see, that grants and donation gift to the non-qualifying benefit entities. Non-qualifying benefit entities are the the qualifying benefit entities. We already seen the list on, even as per the VAT also, we used to consider such entities that are approved in the cabinet decision, or the list of approved entities for the donation or the charity purpose is already available on FTA portal. If we are already giving the donation or the charities to such approved donation bodies, so that we can deduct as in VAT also and here also. But if we are giving to the non-qualifying public benefit entities, the cabinet decision here, the list will be available, the qualifying public benefit entities. But here we are saying, apart from that, we given to any other entity that will be disallowed. So as per accounting, yes, this is the expense, even we given the charity to non-public qualifying benefit entities, but still we can record as expense as per accounting if the relevant standard are allowing us. But as per the city law, Article 33, this thing is disallowed. If we already deducted and we reduce our profit, accounting profit, by deducting such expenses, we will add back. So our taxable income will be increased, tax base will be increased. This is our first point out of the 12 point. Now we're gonna see the second point, interest capping rule. Interest capping rule, we already go through the interest capping rule. We understand how we are applying the 30%, the interest capping rule, but further we will also see more example and we'll do further exercise also. What are the interest capping rule and where are we will apply? The normally the interest capping rule is 30% of the adjusted EBITDA. I'm using the word adjusted EBITDA, okay, or 12 million, higher of 30% of adjusted EBITDA or the 12 million. So whichever the amount is higher, we'll consider that as the interest capping rule. So we already have the detailed understanding in this regard. Hope this point will be the previous exercise in the interest capping rule. Hope you can understand and what are the impact and where it will be required. So hope this point is clear. So what are the article for this? Article 29 to 31 as per city law, you can go through. This is the interest capping rule. Okay, so now here again we already learned that maximum net interest expense allowed as per the BEPS, what is the BEPS? Base region profit shifting, OECD model. Okay, so this interest capping rule, the Ministry of Finance of UAE, they taken from the OECD BEPS model. So what is this model saying and what is the city law is taken the understanding they covered here higher of 30% of EBITDA, but this EBITDA would be adjusted EBITDA or the 12 million minimum safe harbor. If our net interest, what is the net interest? We already understand. If maybe we have interest income and interest expense, so we will plus minus and see what are the net interest expense. Okay, so if we have more income, net interest may be the zero. Now we have the income, so there is no deduction in that regard. But if our expenses are more, so then we have to do the calculation. And what are the formula for calculation? The 30% of higher of 30% of beta and 12 million. If our interest expense, net interest expense less than 12 million, we don't have to do this calculation. We don't have to do this exercise. By default, it is allowed. So we already understand this interest capping rule, the guideline they taken from the OECD action plan, the BEPS. The BEPS do not rely on debt financing, encourage equity. So the second, what are the rationale behind that? There are many rationale. One of the rationale, they want to encourage the people put their own money into the business. They, instead of borrowing the funds from the financial institution or the other. Okay, I'll answer on that. The one of the question. They encourage the investor or the people to add their own funds. This is the one of the reason, but the rationale is behind that because the normally, if one of the European country, they have the higher tax rate, and the other country where the tax rate is low. So how they will transfer the profit to another country? They will take the loan from the another country and then they keep paying the interest to that country. So as a higher country who's paying the interest, who borrowed the money from the another sister concern company and from other associate company or connected person, so he's actually maybe is genuine reason for the business, or as per their practice or as per their analysis, they found the people shifting the profit from the high tax jurisdiction to the another jurisdiction where the tax is low. So similarly, if we've seen that UAE is the corporate tax is 9%, even the effective corporate rate tax is less than 9% because 375% is the first 375% zero rated, and plus another double tax treaty agreement, another that. So net of they may be less than 9%, maybe based on each entity, it may differ, but less than effective rate. We are saying the standard rate is 9%, but we are saying the effective rate less than 9%. Except the pillar 2, there's the top up tax that is 15% for the MNE multinational entities. So here the main principle to ensure that the profit from high jurisdiction will not be shifted to another country where the tax is low. One of the tool or the medium they are using the borrowing, and as a borrowing they are paying the high interest rate to another company or sister company where tax is low. Here we already seen the net interest expense, the interest expense, interest income, plus minus the net interest. Okay, now here the the bullets is added. So as of now, we are looking into that add back disallowed expenses, this A part, and here we have 12 adjustment, and 2 adjustment we already go through, and now we're gonna to the next. Here are the examples that we already seen the previously. We will not spend time over here because I'm just giving the refresher, but the another part that, okay, let me complete that. Okay, here the another point that I want to highlight, adjusted EBITDA. I use the word is adjusted EBITDA. Okay, before starting going through, there is one question from Ms. Farhana. I have one query for the interest ILR, interest limitation rule, as for insurance bank does not apply. That means they can, yes, for bank and the insurance companies, bank and insurance companies, for them, there is no interest capping rule. For them, there is no interest capping rule. The 100% will be allowed. Okay, because these two industries are different. So for these two industries, even the same point that you are asking on the chats, just look over here. Just look over here. Because such point I have the queries or the question from the participant or the clients. So here I just add it over here. So today the main point I want to highlight, okay, let me complete. Interest capping rule higher of 30% of EBITDA at 12 million will not apply to the natural person, bank, insurance provider for qualifying. Okay, you ask only the bank and insurance. Now I am explaining to the natural person also. So here you will please note down the natural person, bank, insurance provider are the qualifying projects. Okay, we already seen the previously also. These are the four item, the four person, the taxable person, where we will not apply the interest capping rule. Interest capping rule will not apply. Interest limitation rule we will not apply. There are different names. We may familiar with a different name. So maybe it's better if we use a complete word, the other participant may understand. But just for your understanding, I'll just highlight interest capping rule, interest limitation rule. Here I already mentioned ILR. The people are familiar with the ILR also. The interest capping rule, ILR, interest limitation rule, the abbreviation is mostly I'm writing the abbreviation also in between this, like here, the brought forward, BD, credit forward, carry forward, just for understanding in between where I use in the text. Okay, now come back. Hope Farhana, your question is answered. Here I want to explain the adjusted EBITDA. What is the adjusted EBITDA? Because for this interest capping rule, we will use the adjusted EBITDA before exempt income adjustment. Before exempt income adjustment. Okay, we have the accounting profit. We have the accounting profit, but as in accounting profit, even the exempt income already added over there. So we will not make the adjustment. Before exempt income adjustment, he's saying that we will keep the same accounting profit before exempt income adjustment. What is that? Because maybe you have some income that is exempt as per the city, but in accounting, as per accounting, this is the income of the company or income of the taxable person. You already added. So here the point, before exempt income adjustment, we will use the same accounting profit without adjusting the exempt income, which means we will not minus the exempt income. Okay, now we use the same figure, but after making 8 adjustment into the accounting profit, means first we will do the computation of taxable income as per the city law, Article 20. So what are these 8 adjustments? These 8 adjustments we are discussing today. After doing all this adjustment, then we will take the EBITDA to calculate the ILR, interest capping rule, interest limitation rule. On which figure we will take, because the interest capping rule or interest limitation rule, as per the city law, they are referring the higher of 30% of the EBITDA or the 12 million safe harbor, 12 million safe harbor, the minimum interest that is allowed. If your interest is less than 12 million, you don't have to worry. But if your interest is more than 12 million, that even in this example, our interest expense is 35 million. If a 35 million, we have to calculate the interest cap limitation rule. We have to apply interest limitation rule. But here because the example is a simple, we have the EBITDA only. There is no other information. So we are considering these are the adjusted EBITDA. So we applied directly 30% of this. But here we are understanding we cannot go simply and apply on the accounting profit. We have to calculate the EBITDA first. Then we will apply 30%. And then that 30% will be our interest limitation rule. Hope this point is clear. I would like you guys to answer on this. If this question, the 30% of the EBITDA before exempt income are 12 million, whichever is is allowable expense under city law. In dash, what will be the text? I appreciate if you guys respond quickly. Thank you, Mr. Khalil. Thanks for Anand. From Hitler Bukhari. Hope you guys are with me. But I appreciate all of you guys to quickly respond on that because this will keep us active in the session. Okay. Okay, now we will go to the next point. This point I already highlighted. The main point I already explained today, the adjusted EBITDA point. Here are the below examples that we already seen. I will not go through because we in the previous session we studied in detail. This is the no interest capping rule on the following person, on the following taxable person, on the following areas or following activity. So this is again, I added over here for better understanding. What are these points? No interest capping rule on following. No interest capping rule, no ILR interest limitation rule will be calculated or applied for on whom natural person, whatever loan he have for his natural own personal activity, as long as what are the personal activity? Personal investment, real estate income. So if he taken the loan for his personal activity, so interest capping rule will not be applied. But here the important part is whatever the activity natural person is doing without trade lessons or do not require the trade lessons, then it will remain the natural person. But if he's doing some activity via trade lessons or even he's doing activity without trade lessons, but that require the trade lessons, this is a very thin critical area or critical point we have to you guys to focus. Natural person doing some activity, business activity that do not require the trade lessons and he do not have the trade lessons is fine. Okay. But a natural person doing some activity that is not that require trade lessons, but he do not have the trade lessons that's subject to corporate tax. And the second is the financial institution, bank and insurance companies, no interest capping rule. The next is the historical loan. Historical loan also in previous session we discussed. Historical loan taken on or before 9th December 2022 for the big public, for the big companies who do involved in the construction like the Expo or the another Etihad Railway or any other public projects, they normally take the historical loan for the to support the public projects. We already go through the qualifying projects. We will not spend more time over here because we already seen. Now we'll continue the next part. Here we are going to discuss the dividend. Point number 3 of the Article 33 out of 12. Out of 12, the point number 3, dividend or profit distribution to the owner. Now, what are our understanding? The dividend, it will be company expense. Would you guys please quickly respond? Dividend is the company expense or no? Is there any specific scenario where such dividend will be our expense that we will deduct in the profit and loss? Is there any specific case where the dividend paid to the shareholder would be our expense and we will deduct from our income statement? Is there any understanding that you guys have? Because this is the point we wish to understand today. The whole topic of understanding is in which scenario we are paying the dividend, but it would be our expense. Just now, one of the participants mentioned the redeemable shares, redeemable preference share, redeemable preference share. Who will understand that? This is because this is the such dividend that is paid on the redeemable preference share would be interest, and that will be part of calculation of the net interest. So that dividend that by name is a dividend but actually is the interest on the redeemable preference share, that we will do add up into the net interest calculation. Whatever the amount of dividend paid, we will add into the net interest calculation. Interest capping rule, that will be part of interest capping rule. How much will be deduct and how much will be carried forward for the next 10 years, that will be part of our calculation in the interest capping rule. So this is the point we wish to understand today. Okay, here if we understand, okay, let's move in the same way. So first we familiar with the shares. Okay. So shares, normally we are familiar with the equity. Now we are here separating into equity and debt, because some share will be equity and some will be the debt. Now let's understand what are the equity and what are the debt. If the equity shares are the redeemable and debt equity shares are irredeemable. Equity shares are irredeemable. On the other side, debt share are redeemable. This is the one of the point understand earlier already mentioned next. So on redeemable share, we will pay the dividend by name, but actually the interest, that interest will be part of the interest capping rule. When we calculating the net interest, so from this interest will be adding over there. Now, how the tax accountant or the tax consultant will know this dividend is actually the interest? Because in reporting, it may be not mentioned over there. If even this is the another current scenario of the market, the most of the auditing firm, they are not giving the appropriate disclosure in the audit report also. Even they are issuing the report without having the proper disclosure as per the IFRS, as per the applicable IFRS, where they are required to have the full disclosure. If such disclosure are not there, so for sure the tax accountant or tax consultant will make mistake over here. That is not by intention, because he do not have the sufficient information. So this point, the accounting team must be known. The accounting team must be known. The GL accountant must be known. The reporting team must be known. So what they have to do, they have to highlight this. They have to highlight this. They have to make chart of account arrangement. So such dividend will be go to the interest capping rule, into the interest expense. Or they might open the dividend as the interest, another chart of account, or they put as a sub ledger of the main account. So if we align our chart of account in a way, the information will be directly going in the appropriate way. When they take out the information for tax purpose or the tax audit, so this information will be available. Why we have to adjust the chart of account? Because even the financial statement is prepared, the reporting person is prepared. But after 7 years, if somebody come back dated 7 years and open the financial statement and he want to trace from where this expense is coming, this would not be easy, because the same accounting team will not be available. If the same accounting team will not be on place, the many story will be changed. How we justify, how we give the supporting. So now we are discussing the traceability. Now we are discussing the traceability. So the traceability is another important part. If we link the chart of account, our traceability of the expenses or item or revenue will be improved. And even none of the previous accounting team members are there, but as quickly anybody can take out the data from the financial statement or the accounting tool, whatever the accounting tool you are using. So this is the importance of the chart of account. If you customize or align the chart of account considering the tax limitation, it will be helpful, not in the recent year, in the current year, but in the future also, to avoid inconvenience in the future also. Okay, before that, we are seeing the irredeemable dividend is optional. This is not mandatory. We have to pay, but redeemable is mandatory. Here the dividend interest is the expense, but on other sides, the dividend optional, and this is not the expense. It would be go to the statement of change in equity, not in the profit and loss. This is the summarized version. This is summarized version that for the dividend or the expense dividend on redeemable shares that we're considering the interest. But I have the in next slide the detailed clarification or detailed understanding to understand this concept. We will go on that also. But here we have some other example also. But before that, the business raise the finance. How they raise? Equity financed by the owners. This is equity financed by owner. Okay. Permanent from equity finance by the owner. This is the what are the advantages or what are the characteristic of such finance? It would be permanent source of finance, no maturity date, discretionary payment, which means is optional. Once the company make the profit, they will make the board will discuss and announce the dividend. It's not mandatory to pay, and is irredeemable preference share. Irredeemable preference share. Cost of equity, dividend optional. Here we understand the owner equity finance. On the other side, if we see this part, the debt part, if we're raising the finance for the company from this part, so what are the characteristics of that? What are the options for that? Debt finance other than the owner. Bank loan, redeemable preference share. The word redeemable means normally we have the vouchers, redeemable vouchers, and many practical life we are having the vouchers. Maybe the care for and Lulu, they also giving the gift voucher, that is a redeemable gift voucher. You can use in the any care for, or you can give that gift voucher to any of your friends or any of your relative if they want. You want, instead of giving the cash, you can give them such vouchers. They are small cards. So this is the example for understanding from our routine daily life. Issuance of school bond, debenture, notes, leasing of assets. But these are all temporary source of finance. These are all temporary source of finance. What does that mean, temporary source of finance? Because there is a maturity date. For all this loan, there is a maturity date. We have to return this loan. Just for our understanding purpose, we will give you the example from our another practical life or the personal life. Just assume that the equity finance you taken anyone wish to start his own business, he took the loan from his parents, his father. So once and you took the loan from your father and you start your business, is your father will come and ask again and again, okay, give me the money. Versus you taken the loan from one of your friend or another relative. So they will frequently come and ask, okay, where's my money? When you will give me money? So they will keep reminding you because ultimately you have to pay them. You have to give some compensation also. But on the other side, the parents, if you took the loans, they will not ask. They will say, okay, we already spent a lot of money on his education, on his other career. So that also may be capitalized or maybe expense out of the sunk cost. So this will be another cost that may be not recoverable. They just put some assumption on this way, and they will not bother to keep reminding for the refund of the finance. This is just the understanding purpose. The example is quoted. So normally, now we'll move to the next and we'll see in the next slide what are the further detail over here. Okay, now our third expense is the entertainment expenses. Now our entertainment expenses. So I wish if you guys give me the some of the example is mentioned over here. And earlier we also understand what are the entertainment expenses. The applicable article for the entertainment expenses is the Article 33 of the City Law. Normally we are familiar, okay, the lunch or the some annual dinner or some meals or something, or the transportation or air ticket or admission of gym or movies. Something like that we are giving to the employees or to the customer, to the partner, to the vendors, and different stakeholder in the business. Yes, colleague, annual party. Maybe another example also will be there. So mostly these are the some of the example, but in each business there were different example. So we have to see what are the allowed and what are the disallowed. So here we already go through the customer owners, partners, suppliers. These business stakeholders is disallowed. These are the business stakeholder is disallowed. No need to check the private element. If we did the entertainment for such stakeholder, it will be 50% disallowed. On the other side, the staff and the employee entertainment expense 100% allowed. Okay, here we've seen the example financing of business, understanding example through equity and finance. We already understand, but now let's move to the next part. Next slide and see the here what we gonna see? What we gonna see? This part shares for the point number 3, item number 3, dividend. Under that, we're gonna understand the shares. This is the important part. I already gave you summarized version, but let's see that in detail also. Okay, the shares normally we are familiar with the uh, ordinary share and the preference share. This is not the performance, this is the preference share. The type order is there. The ordinary share, and now we will see under ordinary share is the shareholder have the voting right, and the preference share dividend liquidation. In terms of the preference share, they have the favor. Yes, please, Mr. Hamza, if company is paying the subscription for the employees also, that also considered in the entertainment category. Also employee allowance also. And like gym, we already mentioned the word gym, so normally the gym membership or annually. The preference share, what are the favors? The preference share, they will get the dividend. They will have the preference in the liquidation. During liquidation, they are the first uh, shareholder who will get the liquidation amount in case of any loss, but they don't have the voting right. They don't have the voting right. Versus the ordinary share, they have the voting rights. They have voting rights. Now the preference share, redeemable and irredeemable. Okay. Here again, the preference share, there is a two category. Why we are understanding in the previous slide, we have just summarized version, and here we are understanding the redeemable preference share and the irredeemable preference share, and this is the ordinary shares. Hope you guys are with me understanding this point, catching this point. Now the irredeemable preference shares are the equity, no repayment. Redeemable preference shares are debt and the liability. Shares are recoverable and recoverable. This is again here we are linking here ordinary share, they have voting right, and these shares are recoverable and irrecoverable. The similar pattern here, the preference share we are discussing redeemable and redeemable. Now here's another point, the equity versus debt financing. Business need the cash for working capital or for expansion or extension of the business and increase its presence in the geographical location. So how they will raise the finance? The equity finance or the debt finance, we already understand by honor issuing of share, and here other than the honor, debt finance. Normally, they take bank loan, issue of bonds, schools, debenture. We already seen the summarized version here. For understanding purpose, we are ending here. And let's complete the debt finance, then we'll come to the equity finance. Now here we're seeing the equity finance by owners, issue of shares, permanent source of finance, no maturity date. This is the discretionary payment, cost of equity, dividend, optional. Dividend paid, not expense. Here we are paying the dividend, but it would not be expense. It would be called distribution of profit. So which means if a distribution of profit, it will not go to the income statement. It will not go to the income statement. It will go to statement of change in equity. Versus here the temporary source having maturity date. We raise the money from bonds, schools, debenture, notes, or leasing of the asset. These are the temporary source, have this fixed maturity date, we have to return. And now this is the discretionary payment, compulsory, we have to return these funds. This is not on the equity finance, these are the optional. Here we are seeing that this is the fixed and the fixed plus variable. So this will go to the income statement. Interest paid is the expense. Okay. Here we are paying the dividend, but we are paying the interest, but we are calling the dividend. Redeemable preference shares. We are paying the dividend, redeemable preference share. We paid the dividend, but actually the interest expense. Okay, now here we added this couple of points. BEPS model, interest capping rule, encourage equity finance and discourage the debt finance. We already understand this point. Again, I'm adding over here. Dividend paid on redeemable preference share is the interest expense. Actually, it's a paid dividend, but on the redeemable preference share is the interest expense. Dividend paid on irredeemable preference share is not interest, not an expense. Before that, here the same point number 3, we have the further clarification, we put the continue, and for the understanding purpose, we go through this part. Let's go to the next part. List of disallowed expenses written in Article 33, 12 item. The same we are discussing the 12 item. So here we already seen the last point. Just for quickly, I'll just go back. The fourth point, the entertainment. Fourth point, entertainment, we already discussed. Now we're gonna move to the fifth point. This we continue. Now we're gonna see the fifth point of the 12 out of 12 item. Drawing of goods from the business for personal use. I appreciate if you guys reply what are the drawing, what is the definition of drawing, and how you what is the understanding that you guys have, what is the accounting treatment we will do. What would be the adjustment in the financial statement? What would be adjustment? Where will make this adjustment? What is the normal practice? What is the normal practice that mostly in not the big companies, but SME companies or the sole establishment or sole proprietor or LLC companies where 2 or 3 partners, what is the practice over there? What is the practice over there? If somebody owner or the connected person or any one of the owner's son and came and take some, if they are in the food item, they might take some eatable item with them at home. Muhammad Adnan is saying he's charged to gift. So he's every day taking food and give to his family and put as expense. Somebody else. I appreciate your response. Mr. Nasser, yes, you are saying correct. Can it be purchase cost? Anyhow, let's reduce to the extent of the amount of drawing. Yes, assets. Okay. Let's understand what would be the effect. What would be the effect for the tax purpose and where would be the effect? Example or illustration, drawing amount is a 5,000. Here we have to understand the drawing amount is a 5,000. What is the example? Income statement, the sale is shown the 100,000. And how we calculate? The cost of goods sold? Normally in the financial statement, we are familiar how we are doing opening inventory plus during the year purchase plus the closing inventory. So this is the formula we are applied to calculate the cost of goods sold. This is the formula we applied. The closing inventory is a 10,000 and now the 60,000. So the net profit will be 40,000. Net profit will be 40,000. But here we written the 45,000. Why? Because we here mentioned the closing inventory is a 10,000. System is shown the closing inventory is a 10,000. But at the year end, when you do the stock count, but you found the inventory value only 5,000, not 10,000. Upon the further investigation, you found that balance 5,000 inventory or the material or item, cloth or whatever the garments or whatever the nature of the industry or nature of the inventory, the owner or owner's son taken at home. But there is no records, there is no entry, there is no bookkeeper because no one stopped to the owner or owner's son also don't take, this is the business property, you cannot take, nobody stop him, nobody make any adjustment, nobody record any expense. But actually now our inventory is a 5,000, what we do? So we have to add back the 5,000, okay? The add back, what is the add back? Because we earlier we said that our inventory is a 10,000. So 10,000 is minus, but now our inventory is a 5,000, which means here you have to less only the 5,000 instead of 10,000. Instead of 10,000, you will minus only the 5,000. That's why we mention here plus 5,000. What is the plus? Because closing inventory minus 10,000 plus the drawing plus 5,000, net is the 5,000. So the effect will coming 45,000. So now what will happen? Our gross profit is increase. Earlier, without drawing is coming 40,000 and with drawing adjustment is coming 45,000. This is the area where we have to adjust. Okay. Now the other normally we already discussed what to do, how to do, but this is the income statement where we need to make the adjustment and show the because what we are trying to understand here, this 5,000 is not the business expense. This 5,000 is not the business expense. Because if you record as expense, so your tax base will be reduced, your accounting profit will be reduced. You might consider drawing as expense in the accounting, but tax authority is saying this is not business expense. This is not the business expense because this practice, if continue, so most of the tax person, they have this practice. In certain industry, they can use the similar fashion. I know I have one of the client where they are dealing in the the luxury car. They are giving the rent a car, but normally rent a car for luxury car they use only 2 to 3 years, not more than that. After that, they sell out the car. So they always have the new brand, new models, the car. So what they will do, they even if such more than 100 cars, the luxury cars, they have it. So what they do, they purchase the car because if they purchase, even the family or the owner or the connected person, they use the same cars for personal use. Actually, they are buying for personal but under the business name. So if they are recording under the business, So they are claiming back the VAT also, because every year they are changing. If they every year they purchase for personal use, they cannot claim back the VAT. So just imagine the one car value maybe the uh, approximates 800,000, approximate 500,000, 300,000. These are the all luxury cars with the customized car, the advanced cars, the model cars. So even the average amount, we say the 200,000, how much the VAT amount? If they put under personal, they will lose that VAT amount also. But they are putting under business and they keep using for personal also. Even they purchase for their family members, but they're recording in business. So such expenses we have to highlight, we have to ensure if any expenses belongs to the owner, we will not deduct from the taxable income. Even in accounting profit, we already deducted. So here the GL accountant or the accounting team, he have to put some information in the chart of account. At the transaction level, he will highlight, okay, these are the expenses as per the tax is not the deductible. So this is the role. This is the role of the GL accountant. If he knows the tax, if he's familiar with the tax regulation, it will help to improve the reporting. It will help to improve the compliance also. It will help to optimize the taxation regulation also, and to ensure the tax return filing also. These are the key area that is required. See, as of now, your amount is recoverable, not recoverable. That is another topic. We will know if the owner are using the cars for personal, how to bifurcate. See, these are the gray area, very gray area. The example what I shared, this is the very common, and it's apparently seem they are buying for the personal. But in certain area where the owner is using for the personal as well as for the business also, you can make the company policy what are the certain amount is using for the business and certain amount for the personal. But before that, another point we have to look over here. If the owner, now I'm gonna give you example. Owner will take the car for him only because he is the share MD, managing director or managing partner or chairman. So if he's the on genuine case he's using the car for company, yes, it would be allowable expenses for the juridical person on arm length basis. But if the same owner or the person is giving the car to his wife also, although they are not working, so what will be the rationale on that? That's one thing. This is the gray area. You have to be very careful and understand. Yes, you can deduct as per, or if the CEO, because the CEO salary also will be deduct. You are paying the CEO, chairman, whatever the acting partner, you are paying the salary also under the LLC or juridical company that also deductible as per the ALP road market value. So this the company car also provided as a company allowance, traveling allowance, transportation as per the company policy. Yes, it would be deductible, but how much if you give to his wife, his to son, then you have to see the rationale behind that. How you can justify on that. Hope this point is understand. This is the point that you were asking. This is the point. Reasonable apportionment. And the owner using car or son is using car who's active now here. Reasonable apportionment, but because on case to case, on maybe the same expense for the one entity is a different, another entity is a different case. So here the word is a reasonable apportionment. So we may say the 50-50, we may say the 60-40, we may say the yes, Rana. Here we are making the reasonable apportionment. Yes, if here we have to see what are the accounting standard, what is the accounting standard guideline, what are the accounting standard guideline, but as per the what are the company policy. But as per the city law, again, are this benefit for the juridical person, for the LLC company? Make sure this is not applicable to the natural person. This is not applicable to sole establishment. This is not applicable to the unincorporated partnership. All this point, the question your Ms. Farana is highlighting, this is not available under that scenario. But for juridical person, yes, these are allowable. You can deduct on arm length basis. Okay, now we see the another part. Business usage is allowed, private usage is allowed, where the personal limit included into expenses. Here the same, the car expense, telephone expense. So maybe we already, as per the VAT, we already have some company policy, we have some allocation, the 70-30, 60-40, or 50-50 for the car use and the telephone use. So we may keep the same over here also. So here the word reasonable apportionment, because the burden of proof on you, because taxable authority may ask, okay, what is the rational, what are the reasonable apportionment, why you allocate in this way, why you deduct this expense. We have to prepare our rationale behind that. We have to do our exercise. Next, move to the next. Point number 7 out of 12. Recoverable input VAT expense, irrecoverable VAT. Here the point, irrecoverable VAT is allowed, and recoverable VAT did not claim. Recoverable VAT, but we forget to claim in the VAT return, disallowed. We cannot, in accounting we put as expense, but under the city competition we cannot deduct. Irrecoverable VAT example, restricted vehicle, 1% private use, entertainment expenses. Okay, restricted use, 1% private use. So we may be seeing that example before also, but let's see. Yes, these are deductible, but VAT guidelines are there. Please follow the VAT, have very public clarification on such areas. Follow that. If you follow that, for sure it will be complying in the city also, because the VAT public clarification is there on this area. Please go through and do the appropriate understanding and apply on that. But as concerned for a city law, yes, is a deductible on arm length market value basis. This is the city law is saying for the LLC and the natural person for unincorporated partnership for employees. All these expenses are deductible. Only the owner salary, CEO salary in the natural person and the unincorporated partnership, that is not deductible. Here we see the purchase, the 100, and the input VAT is 5, cash paid 105. While making the transaction or recording the transaction, our bookkeeper, they did not record this 5 as a VAT input. It put a recorded as expense, but this expense is the claimable. Okay, but if you did not claim, so then we cannot record as expense. So this is the example, recoverable and unrecoverable. Let's move to the next one. This we already go through the previously in detail. Expenses incurred on the non-taxable activities, expenses incurred on, here's another technical point, expenses incurred on non-taxable activities, which means maybe there is some activities that is exempt from the city law, out of scope from the city law. Here in accounting, if you guys, I appreciate if you respond. What is the matching concept? Please, I appreciate quickly respond on the matching concept. Accounting principle. Guys, quickly please respond on the matching concept, because this is important to understand. Okay guys, most of them giving the correct answer and they have the correct understanding. Okay, here by using the same what we're understanding, the expenses and income should be booked in the same period. Now here we're saying it's expenses and income should be booked in the same period. Take the same understanding and see. If we are saying the expenses and income book in the same period for the matching purpose, but here if the income itself is out of scope, can we deduct that expenses from the city competition? If income is not falling under the tax, income is exempt from the tax. So accordingly, the expense belong to such income, will be expenses belongs to such income who's exempt from the corporate tax, not non-deductible. Okay, so we have to see maybe in the accounting team, they already record these expenses, they already deduct these expenses, and they reduce the accounting profit. They already reduce this profit. So we will, if we are excluding the income, we have to exclude the expenses also. We have to add back such expenses also. Hope this point is also understand. Here we are giving the example like broker fee, commission fee. If we buy the shares, yes, Ms. Rana, okay, I'll give you the, let's continue, keep the under 8 point. The 8 point, okay, I'll give you the example for the shares. If we buy the shares of the local company, if you buy the shares of the local company, so and you get the dividend on the such share on the annual basis. So now in the previous session, we understand the dividend from the local company we receive is a taxable. Ms. Rana, please give me the answer on that. Okay, guys, this not taxable. Okay. If the dividend is not taxable, so whatever the expenses incurred to buy that shares, that would not be deductible. Because you buy the share of the local company through the broker, through the banks, okay, the IPOs. Most of the major banks are there, they offering the brokerage services. So when you buy the shares, they will charge a brokerage fee, commission, legal fee through the broker and their service fee. And when you sold out, they again will charge you. So all these services, if the on that income from that shares or that dividend we are saying is not deductible or not taxable, then these expenses also will not be deductible. These expenses are not be deductible as the income is exempt. Accordingly, the expenses will be disallowed. Accordingly, expenses will be disallowed. Yes, Farhana. Hope you understand the point number 8. Please quickly. Now I'll come back to the point number 7 again. Here what I'm saying, okay, give me the example of any VAT that is we cannot claim back from the FT. Quickly give me any of the example that coming in mind. Yes, this is the VAT we paid, but we are not claiming from the FT and the VAT return. Or any other person. I appreciate if any other person can give me the example. Okay, here the penalty, one of the word is used, fines. Okay. If you paid the penalty, so that now the penalty also will be a gray area, because if we take the example, there will be penalty another topic in the VAT, because the penalty if you paid as a contractual term, that story will be different. The fine, the word fine, if you paid, you made the the violation of the law, and you paid some fine on that. No word on the fine on that. Let's assume that any other example, if you guys are give me any other example, I'll take that. Okay, I'll take the entertainment expenses. VAT is recoverable on entertainment expenses for the employees. And how about the other stakeholders? For the if we give the entertainment to the customer, to the supplier, the VAT is claimable. Please answer quickly. If we paid the VAT, Mr. Khalil is saying not claimable. If you're saying not claimable, so how if we say irrecoverable VAT? Mr. Khalil is saying not claimable, so I said, can we name in the irrecoverable VAT? Let's keep the same example. If we spend the entertainment expenses for the other stakeholder apart, not on employees, apart from employees on stakeholder suppliers, or this is not for business purpose, so this is not claimable. So can I see the not claimable is irrecoverable VAT? Ms. Farhana, would you please respond? These expenses that we are seeing not for business purpose are the other stakeholder. We paid some amount and the VAT is not claimable, is called irrecoverable VAT. If this is the case, then in city competition, these expenses will be allowed. We can deduct these expenses. Normally in accounting, we already deducted. In accounting, we already deducted all these expenses from the accounting profit. So that is, if we already deducted, is allowed. Is allowed expense. Okay, just keep the same example for understanding. We will. Okay, now another part. Now here we are saying the recoverable VAT did not claim. Here you buy some goods for the business purpose, some inventory for business purpose, but which means the VAT can be claimed. But the bookkeeper, they did not put the unclaimable VAT. What he did, instead of making the entry purchase 100 and VAT 5 and cash is 105, what he did, he put cash 105 and purchase 105. He did not apply he did not record the input VAT. So by mistake, he put the input VAT also as a expense, as a purchase cost. He increased the purchase cost. So this is recoverable VAT by due to some mistake or maybe the forget, you did not claim. So these VAT is a disallowed. So this VAT you already put as expense. Now the city as per city they're saying you have to add back. This is the disallowed. You have to add back. Guys, hope this point number 7 and 8 is clear. Please quickly respond on that. We are spending too much time on that. Thank you, Fana. Thank you, Asif. Thank you, Salman, Adnan, Khalil, Hamza, Tufail, Niha. Guys, as of now, 29 participants is shown, but only a few participants is taking actively participation in this discussion. I appreciate you guys actively respond on that and take the participation. And by keeping that, I just appreciate if you guys now in the market, the many job seekers are there. You try to help them, try to explain them, try to support them for understanding the city law, the basis of what city law. They don't require to file the corporate tax return, but if they understand the basis of the taxation, the overall framework of the corporate tax, they might put in the interview to the interviewer the understanding. They know this is the fresher, but they will appreciate their understanding and their interest to learn the city also. Try to support the job seeker also in your community, in your circle, wherever you are. Let's move to the next. Here we already understand that the exempt income, local dividend, we already go through always exempt. If always exempt, the associated expenses will not be allowable expenses. If we already deducted, we will add back. Let's move to the point number 9, losses on taxable activities. Losses on non-taxable activities. This is the similar concept. This is the similar concept of this. Point number 8. Point number 8. Expense incurred on non-taxable activities. We said, okay, if income is exempt, so we will not deduct the expenses also. Now here, if the same income, you have the losses, on the same, you have the losses as income is not taxable. So then losses also you cannot adjust in the city computation. Losses cannot be adjusted in the city computation. Participating interest exemption, participating interest exemption. This is another big concept also. The first point is, hope is participating interest. What is the participating interest? You have the as the shares buy from the local company and you're getting the dividend is exempt. But how about if you're taking the dividend from the foreign company? You have the buy the shares of the foreign company and you are taking the participating exemption. Okay, the participating interest, losses on taxable activities, non-taxable activities. The concept is remain same. If the income is not taxable, the losses also will not be deductible. Losses cannot be carried forward. Losses cannot be carried forward in the future also. Okay, let's see. Participating interest. If we buy the shares of the foreign company, so we'll get the dividend. And the local company dividend we already said is the exempt, but the participating exempt. The local dividend always exempt. We don't have to calculate all this calculation. The participating interest share the exemption, foreign company dividend, gain on selling of shares. So from participating interest, we will have two type of income, the dividend as well as the gain on selling of shares. So gain on selling of shares, it might come from the local and foreign also. So what is the understanding of the participating interest? I would like to understand from you guys, what is the understanding over here for the participating interest? I appreciate if you guys share understanding over it. I would like to volunteer you guys, because if I continue, you guys may be not able to understand that part. Participant. Okay. Please send me a message. I'll open the mic of the participant who want to answer on that understanding. Quickly, only the person who have the understanding of the participating interest, quickly. Well, I appreciate if anybody would like to participate. Kamal. Okay, fine. Okay, any other person? Any other person? Okay, Hinjal Kaval. No, sorry, Hinjal Makhanwa. Sorry, Hinjal, would you please unmute yourself?
Hello.
Yeah, sorry for your name. Please explain what is the understanding in this record.
So, if judicial person is having shareholding in another company for a non-resident company more than 5%, it's called participating interest. And he's having like the holding period should be at least for 12 months. So
Any
if
other?
and if that company is paying, it means if that company is paying the tax, then both the companies should not pay the tax on the same income.
Okay, thank you, thank you. Okay, here the Ms. Kinjal already explained the point. I'm gonna explain you the same. Let's say we buy the share of the Apple. Let's say this for the understanding purpose, we buying the share of the Apple, or the WhatsApp, or the Facebook, or any the share we buying, that is the company in the outside UAE. So if that share you are buying from the outside company, the foreign company, so you the condition to take the exemption, all this exercise all the understanding we are doing to get the exemption. What is the exemption? We will not pay the tax. The simple, okay. Participating means we buying the shares. What is the participating? The word interest is the share. If the participating, we participate in the shareholding. If we in common understanding, we are participating in another company shareholding. What would be your participating? What would be your shareholding? City law is saying more than 5%. 5% or more than 5%. Or the minimum investment is the 4 million. Or the minimum, even your shareholding is less than 5%, but your amount of investment would be 4 million. This is the condition, but this is the complete topic. We will go and in that topic we'll have the example also for understanding. So now if we meet this condition, because local dividend we already said is the exempt. The foreign dividend, this condition has to be satisfied. If it's satisfied, yes, that dividend will be exempt. You will not pay the corporate tax on that income also. This is the criteria to get the exemption while having the shareholding in participating interest in the foreign company. The same way we will have the capital gain or loss on selling shares on local also and foreign also. The same way, if the first principle is satisfied, the second will be satisfied. In UAE, we don't have the capital gain tax, the same corporate tax. The gain also will be calculated under the standard rate at 9%. Foreign dividend income and the gain will be part of the calculation if the other condition is not satisfied. If we seen this condition are satisfied, condition are met, then it will be exempt. Ms. Kinjal already mentioned the other condition also, that keep the 12%, the 12 months. For the dividend, if you take the foreign dividend, your intention to hold the shares is at 12 months, is not actual holding is 12 months. Here we mentioning if your intent to hold for 12 months, if you meeting the condition of the 5%, are you 4 million, and your intent to hold the 12 months, then your dividend will be exempt. But here the participant, they are asking, what if we sold the shares? What if we sold the share before the 12 months? What if we sold the share before 12 months? Okay, at the time of return, you are filing the return, you have the intent, but after the year end, when you file the return, you sold the share. So in next return, it will be taxable. Next return, it will be taxable. Okay, now the capital gain, in terms of the gain, they're saying actually holding period is a 24 months. Actually holding is 24 months. Anyhow, we will go in detail, but hope the concept here we are saying our topic is here the losses on non-taxable activity. If this income is we already claim the participating interest exemption. So if the losses on upon sale, if there is a loss, that also will not be deductible. So this is the understanding. Now the personal expense is generally not allowed. The nature of expense is the personal nature is not allowed. Okay, here the illegal action, bribe, payments. Okay, these are if you are giving payment and you are recording the expenses in accounting, but in the city competition you have to add back, disallowed. The last, any other payment by the ministerial decision or cabinet decision, any other expense or payment that you made per ministerial decision is disallowed, so that you will add back. So these are the 5 points. Here I summarize again these 5 points. The list of non-deductible expenses, 12 item, Article 33. Here the donation, gift, grants to the qualifying, to non-qualifying public benefit entities, illegal acts, fines, penalties, bribes, payments. The point 3, dividend or profit distribution to honor and payment. Any payment not fixed or contingent on financial performance. Drawing for personal use. Irrecoverable input VAT. 50% of entertainment expenses of supplier, customer, and shareholders. Interest capping rule. Interest limitation rule. We familiar the personal expenses. Expenses incurred to get non-taxable income, domestic dividend. This we already go through that. Losses incurred on non-taxable activity. 11 is reasonable apportionment. 12, any other expenses as per ministerial cabinet decision. Guys, quickly give me the response. The hope this point is understanding. This is as so far we covered only the point number 9. Point number 9. Just now we have the detailed understanding. The say if we have the participating interest, which means the income receiving under this shareholding, under this activity, under we buy the shares. So we are getting the dividend, we are not paying the tax. If we are not paying the tax because we met the condition and we got the exemption, then if in future when we sold these assets, then loss will be arise. Okay, if you're selling, the share price is reduced, you are selling, you have the loss, that loss also will not be deductible. The losses in accounting, you may be minus, you already deducted, but for city competition, you have to add back. Why it is not visible? Okay, guys, maybe the color is not visible. Any of these points already we covered. So maybe due to color combination, it might not be visible. But and the sequence is also not the same. But mostly we go through in detail and 12 point. Add back point. See, add back point, we the point number first, and we have the very detailed understanding on that. Later on, you go through the recording, you will understand that, please. So here the interest limitation rule, BEPS region action plan 4. Okay, there is a detail we already go through. Here is summarized version, but we'll discuss later. this slide. Let's take the example. Let's take the example because the journal interest deduction rule. Corporate tax liability calculation. Determine the taxable income and UAE liability in following example. Assume all parties to be taxable. Okay, guys, quickly go through and give me the answer on that. We seen in the last session and today also we go through quickly. I appreciate you guys to work on that. So let me share it. Please confirm now screen is shared. Still not. Okay, let me go and okay, this is the last slide where maybe there's 1 minute is something went wrong. Just Okay, guys, I'm sorry that there was some issue that was not working the participant. Okay, guys, you already sorted out, and I appreciate if you would like to volunteer yourself and explain this. Please volunteer yourself. I'll open the mic. Only the 10 minutes is left. Anybody would like to participate? 15 million, 30 million. Okay, let me read that. The CLC has a revenue of 150 million and adjusted EBITDA. The word he used, the adjusted EBITDA. The word here is using the adjusted EBITDA. But basically, I can choose. Okay, let me read. The CLC revenue is 150 million, adjusted EBITDA of 130 million, and the profit before tax is 60 million for its financial year 31st December 2025. Here the adjusted revenue is 150 million and adjusted EBITDA is 130 million. So there is a 20 million difference. There is a 20 million is a difference. This is the adjusted EBITDA. The revenue is 150. Adjusted EBITDA is 130. Profit before tax is 60. In 2025, CLC incurred costs, including interest expenditure of 18 million. In 2025, the cost incurred, including interest, is 18 million. So how much the cost? How much the cost? CLC also received interest income of 30 million, resulting in a net interest expenditure is 50 million. So here he already gave us the net interest. We don't have to calculate. Why? Because interest expenditure is this much and income received is this much. So net interest is 50,000. How much interest is deductible for the year of 2025? So now we have to calculate the, I would like if somebody explain the law also, what is the law guideline and on which figure we will take that, Okay, Mr. Khalid is mentioning. Okay. Here we have to see the adjusted EBITDA 130, profit 60,000 of the financial year. Let's quickly go through because that time is already over. CLC may deduct net interest expense of 50,000 up to greater of 30% of its adjusted EBITDA or the de minimis of 12 million. because the interest expenditure is a 50 million, so it would be more than 50 more than that. So we have to calculate the interest capping rule. So adjusted EBITDA is already he gave us adjusted EBITDA is already gave us. So the 30% of the CLSC adjusted EBITDA. Okay, 30%. This is the adjusted EBITDA he shared with us. So we have to take the 30% of that would be 39 million. 39 million. So now the rule is that whichever is a higher, hence the maximum deductible limit is a 39 million. Net interest in 2005 is a 50,000 and CLC may deduct only 39 million of net interest in the period and 11 million. Farhana have some question. Net interest is a 50 million and CLC only deduct 39 million. So 11 million will be carried forward for the future year on the FIFO basis up to 10 years. Yes, Farhana, what's your point over here? If the net interest expense is 30 million, then less than 29. Yeah, but why in this example, in this example, why we are taking the 35 million? We have to calculate in the on the total 30% EBITDA. But just for your understanding, yes, it will be all will be allowed. But we are taking our understanding in the current example. Okay, let's move to the next quickly if we can complete that also. Okay, guys. Quickly, this will be our last example for today's session. Guys, in terms of your session, I believe we are going fine, and you guys are learning the corporate tax implication, and it would be productive for you to upskill your tax expertise. And we are discussing with Mr. Sayed also. We will issue the certificate also for the participant who complete all this session. Who complete all this session. That certificate may have the value in your profile as well. Yes, guys, hope you completed. Okay, guys, we will gonna stop here and we will start in the next session. Okay, let's Okay, I have two different answers from the here. Another concept is actually right. Okay, Fawad Aziz 20 plus 31 million. Here, sorry, Miss Hinjal, this up to 75%. No. This 75%, please ignore this 75%. This is for the losses. This is for the losses. Maybe in the last session, the 75% is mixed in this, but there is no 75% on the interest capping rule. Interest capping rule is 30%, and then they carry forward from the previous year for the and whatever the left loss, it would be carry forward for the 10 years. This is the interest capping rule. 75% we will discuss in the loss relief group. 75% we will discuss in the loss relief. Please ignore this 75%. Whatever the loss, see here the continuity of the previous example. What is that? Because the 11 million is the left in the first year. Now here that is the 2025 and here is the 2026. This is carry forward, and this year net interest is a 20 million. And if we have the adjusted EBITDA is a 180 million. So, but our total, what will be our interest capping rule? 30% of 180. This will be how much? The 30% of 180. You guys mentioned 54. So our we can utilize the interest we can deduct up to 54, but we have only 20 million in this year plus 11 million from last year. So 20 plus 11 here now on FIFO basis. So we have the here the room 54 million. So 20 plus 11 we can deduct the full amount this year. But if instead of 11 million, if we have the 40 million carry forward, let's assume here is the 40 million carry forward and 420 is here. So total is a 60, but our current year cap is a 54. So 54 will be deducted this year and balance 6 million will be carried forward for the future year. But that case 6 million carry forward will be from this amount. Anyhow, let's see the solution of this. In 2026, 30% of LLC adjusted capital of adjusted EBITDA of would be 54 million that we calculate, which is above the minimum limit. Hence, which is above the de minimis, because the minimum is 12 million. Now we have the 30%, which means 54 million. This is the our limit to utilize the interest expense. Deductible net interest expense can be deduct all of his net interest in the period of 2020 of the period 20 million. Here the point we have to understand only. First, we will deduct the 20 million for the current year, then the brought forward. As well, additional amount up to 34 million of net interest expenditure in this period. Hence, it may utilize its carry forward net interest, that is 11 million, from 25. Further, it's reduced the taxable income. Hope this point is understanding is clear. Okay, guys, if you guys have any question, let me know. For the attendance, quickly, I'm just taking the screenshot. It will be marked in the screenshot. Who are the, just quickly mention yes, up present, all of them quickly. And if you have any other question also, just let me know. Yes, let me know. I'm just scrolling down the screen and this will be marked as the attendance also. It is only not all people. Okay. Okay, guys, you guys have any question? Yes, please. Today's session is completed. So if you want to leave, you can leave. And if somebody have question, I wish to answer that. Okay, guys, thank you very much. See you in next session.